The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers.
Nifty Sensex end higher for the second straight day. Broader markets also followed the lead to end in the green. Barring realty, all sectors closed higher with oil and gas leading the gains. The dollar weakens to fourth-month low. According to reports, Trump's tariffs could slow down economic growth in the US. As a result, the rupee is showing signs of strengthening. Retail car sales take a hit in February, dropping over 10% according to data from the Auto Dealers Association. The downturn was driven by inventory mismatches, leaving dealerships struggling with financial strain and mounting unsold stock. Apple BKC gets an unwanted neighbor as Tesla makes big plans to roll in just 120 meters away from its Mumbai store in BKC. In a 2021 lease signed for the store, Apple mentioned Tesla as one of the brands that cannot set up shop at the Geo World Drive. US President Trump threatens further destruction of Gaza if all remaining hostages are not released. In a last warning, Trump also issued an ultimatum to Hamas leaders to flee while they have the chance. Good evening, hello and welcome. This is Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. Benchmarks closed in the green for the second consecutive day, with Nifty gaining 207 points and the Sensex climbing over 600 points. All sectors closed positively except for realty. Now, top sectoral gainers included metals, pharma and FMCG with gains over 1%. My colleague Anushi now joining us with a detailed market roundup. Anushi, over to you.
Hey, thanks for that, Sanjana. So as we see, benchmark indices continue the signs of recovery, and this is for the second straight session that we are looking at. Again, these two sessions in green is after the 10 sessions of red we have seen in the market. So some bits of recovery in both the benchmark indices and broader markets have been continued to do better than the benchmark indices if you see. In fact, talking about Nifty 50, it hit the 22,500 mark after 5 sessions, and Sensex hit a 74,000 mark again after 5 sessions of trade. Some of the top stock movers in the Nifty 50 include Asian Paints, and this is on the back of falling crude oil prices, which is why it was in focus, and Coal India. Now Asian Paints have ended with gains for second consecutive session, while Coal India ended with gains for third consecutive session. All sectoral indices ended in green except for Nifty Realty. Here, Nifty Oil and Gas and Nifty Metal emerged as the top sectoral gainers. If you talk about the stocks in the Nifty Oil and Gas space, Castrol India and Mahanagar Gas led to this higher contribution that we are looking at. Nifty Metals continues to be in focus. Now, this is for the 5th straight session that we are seeing it continue on its winning streak. Top Nifty Metal stocks include the likes of Jindal Stainless and Hindustan Zinc. Now, talking about the one sector which was in red is Nifty Realty, and this ended in red after snapping its 3-day gaining streak. The top Nifty Realty laggards include the likes of Macrotech Developers and Godrej Properties. Broader markets continue to outperform benchmark indices as said earlier. Nifty Midcap 150 ends in green for the 4th consecutive session, while for Nifty Small Cap 250, we are seeing these gains coming off for the 3rd consecutive session. Talking about some of the key market cap additions that we are looking in large cap, we are seeing about 6.7 lakh crore of market cap addition, and this was led by Reliance Industries and Bharti Airtel. In mid cap, we saw addition of market cap of around 2.49 lakh crore, and this was led by Lloyds Metals and Hitachi Energy. In the small cap space, we have something like a hospitality and Brainbees Solutions and First Solutions in focus. Small cap saw an addition of over 1.74 lakh crore in market cap today. So this is the overall view of the markets today. Broader markets continue to perform benchmark indices, while benchmark indices continue to see signs of recovery for the second day.
Thank you so much for bringing us those updates. Indices extending recovery to second day. And meanwhile, Indian FMCG companies are likely to grow 8 to 10%. This is what Milind Karmakar of Dalal Brocha had to say about the winning sector in the bucket of consumption. Let's listen in.
So retail is my most favorite. Then comes platform companies. FMCG currently, we normally don't invest because we have seen that, say for example, in the United States, when organized retail just started, at that point in time, the top 5 companies in the US were FMCG companies. 20 years later, top 5 companies were all retailing companies because the pattern of control over prices moves from FMCG to retail. That's what happens. And that is also likely to happen in India. So in India, most of these large companies like FMCG companies, like whether it's HUL or these are mature companies and they are likely to grow at 8 to 10%. But beyond that, whether they will grow, I don't know. And since we focus on only those companies or those sectors which can grow higher than the nominal GDP growth, we would be underweight or we may not own these companies.
And more good news is the dollar index has dropped to its lowest in 4 months due to concerns on US economy growth. Trump's tariffs might slow the US economy, hence leading to a stronger rupee. Meanwhile, the rupee closed at 87.11 against the US dollar, down about 0.2% on the day. Pallavi is here to explain the impact. Pallavi, over to you.
The US dollar has been seeing incurring sharp losses. It slumped to the lowest in 4 months, and that's amidst the uncertainty over US economic growth prospects. The dollar index that measures the greenback against a basket of currencies is quoting at about 104, and that's similar to the levels we last seen only in November last year, and that's compared to highs of almost 108 we'd seen earlier this year. Now, this is all on the back of doubts that Trump tariffs will slow down the US economy rather than being pro-growth and inflationary. That was the concern, that it might be inflationary earlier on. Moreover, losses in the dollar have also been accentuated by gains that we have seen in euro amid expectations of increased defense spending and borrowing in Europe that's expected to help revive the struggling eurozone economies. Meanwhile, the British pound has also strengthened from expectations that UK interest rates are bound to stay higher for longer. Now, currently, the euro against the dollar and the Great British pound against the dollar are quoting at their year-to-date high of about 1.07 and 1.28 respectively. In all of this, the rupee is seen at levels of about 87. That is where we are at currently. We did see some strengthening in the rupee yesterday, and we've also seen some positive news coming in from the central bank, which the rupee is also benefiting from. The central bank last evening announced that it will conduct OMO purchases of government securities worth 1 lakh crore rupees and USD INR buy-sell swap auctions of $10 billion.
Pallavi, thank you so much for putting that in perspective. Meanwhile, India's External Affairs Minister S. Jaishankar has stated that India has no plans to replace the US dollar as a reserve currency. He emphasized the need for global economic stability. Speaking to the media during his London visit, he stressed the importance of working with the United States to strengthen the international financial system.
First of all, I don't think there's any policy on our part to replace the dollar. As I said, at the end of the day, the dollar as the reserve currency is the source of international economic stability. And right now, what we want in the world is more economic stability, not less. Now, obviously, there are, I would also say, in all honesty, I don't think there's a unified BRICS position on this. I think BRICS members, and now that we have more members, have very diverse positions on this matter. So the suggestion or the assumption that somewhere there's a united BRICS position against the dollar, I think is not borne out by facts. Again, I'm not, to me, it's kind of deterministic that if there is multipolarity has to translate itself into a currency multipolarity. It doesn't have to. Again, even when I was explaining multipolarity, my point was that if there are multiple players, it's not that India's relationship with each player is the same. There are different considerations in each relationship. For us right now, we think that the United States as really, in many ways, clearly the largest economy in the world, in many ways, the almost the fulcrum or the key player in the global international architecture. Our own relationship is growing. It's very positive. We do believe today that working with the United States and strengthening the international financial system, economic system, is actually what should be the priority. So I think that both a strategic assessment as well as our sense of what is required today by the international economy will really guide our thinking on this matter.
And it's our big story for the day. Great news for auto fans. It is official that Tesla will open its first ever showroom in Mumbai's BKC, Bandra Kurla complex. Now, the company has put down 2.11 crore rupees as security deposit for the 4,000 square feet showroom space, which is nearly the size of a basketball court. My colleague Tushar joins us from the location to tell us more.
They're outside the Maker Max City building in Bandra Kurla complex in Mumbai, where Tesla is set to open its first India showroom. Tesla has actually leased a 4,003 square feet space in the ground floor of this building at 881 rupees per square feet, making it the biggest or the most expensive commercial real estate deal in India. Second only, or actually more expensive than the Apple BKC store, which is also behind me at this point of time. A total of 2.11 crore rupees has been deposited as a security deposit, while the rent is set at 36.25 lakh rupees per month. The rent will increase at 5% per annum. The total lease is for a total of 5 years. Tesla is expected to open a second showroom at AeroCity in Delhi. The first model that is likely to come into India is the Model Y at about 60 to 70 lakhs. The other model that can come in if Tesla is more aggressive with the expansion would be the Model 3 at about 30 to 40 lakh rupees in India.
But clearly not everyone is excited about Tesla's new showroom coming up, because BKC's Maker Max City is next to Geo World Drive, which houses Apple's first showroom in India. And the iPhone maker in its 2021 lease mentioned Tesla as one of the brands that cannot set up shop in Geo World Drive. And now the distance between Apple BKC and Tesla BKC would be a mere 120 to 200 meters. And with Tesla's much anticipated entry into India's auto market that is just around the corner, there's a significant development. The United States wants New Delhi to eliminate tariffs on car imports as part of a proposed trade deal. According to the media, India is open to reducing these tariffs but is not yet willing to bring them down to zero. These media reports have also indicated that the high tariff issue on car imports will be a key point in the formal talks for a bilateral trade deal between India and the US, which is yet to commence. Now, it is important here to note that India imposes taxes as high as 110% on cars imported from the US. In the past, we've even seen Tesla CEO Elon Musk criticizing India for having some of the steepest tariffs in the world. And there's positive news for the US automobile industry. President Trump has announced a 1-month break from the proposed tariffs on imports from Mexico and Canada. This break aims to prevent harm to domestic manufacturing caused by potential retaliatory tariffs from Mexico and Canada. Automakers have asked Trump to waive the 25% tariffs on cars from these two countries that meet the United States, Mexico, Canada agreement's trade rules. Meanwhile, White House Press Secretary Carolyn Leavitt shared that this pause on tariffs followed discussions between Trump and leaders of the major automakers, Ford, General Motors, and Stellantis. Let's listen in.
I can confirm, and I'm glad that you asked because the president sent me out here with a statement directly from him on this. I saw it was reported earlier today by Bloomberg News, and he wanted me to share this with all of you. We spoke with the big three auto dealers. We are going to give a 1-month exemption on any autos coming through USMCA. Reciprocal tariffs will still go into effect on April 2nd. But at the request of the companies associated with USMCA, the president is giving them an exemption for 1 month so they are not at an economic disadvantage. So the three companies that he spoke to are Stellantis, Ford, and General Motors. They requested the call, they made the ask, and the president is happy to do it. It's a 1-month exemption.
Meanwhile, India's auto retail sector hit a speed bump in February with car sales plunging over 10%. That's according to the latest data from the Federation of Automobile Dealers Associations, also known as FADA. Now, what's driving this decline and what does it mean for the auto industry going forward? My colleague Puneet now joining us with all of the details.
Federation of Automobile Dealer Association, of FADA, came out with its February 2025 sales data, and it was a negative 7% which was registered in this particular month, or a 7% fall in sales. Now, when you look at some of the key aspects, the highest falls in terms of sales was registered in the tractor market, down almost 14.5% in this particular month compared to the same time last year, while on the other hand, the passenger vehicle or the four-wheeler car market was down almost roughly 10% in this month. We also saw the commercial vehicle or the truck space down by 8.6% in this particular month, and the two-wheeler space was also down by roughly 6%. So overall, the major categories all were down in this particular month in terms of sales estimates. Now, when you in terms of actual sales, when you look at the two-wheeler space, it has registered an 8.5% growth for the first 11 months, but in this particular month it had a 6% fall, and it's also interesting that the urban markets have declined more than the rural markets in this particular month according to FADA. Apart from that, when you look at the passenger car space, it has been a lackluster year with just 4% growth seen across the first 11 months, and in this particular month we've actually seen a larger fall of 10% in terms of sales again. Entry-level car segment has particularly remained soft, and that's a trend that's been continuing for a while. While we did see some growth from players like Maruti in December and January in the small car space, that trend hasn't continued in February. When you look at the commercial vehicle or the truck space, and that has been impacted due to lower infrastructure spending by the government of India, partly because of elections and then monsoons as well. The sales have also been hampered in this whole year. Apart from that, the sales have declined in this in the first 11 months by 0.5%, and this month it's seen a larger 8% drop. In commercial vehicles specifically, dealers have reported weaker sales in the transportation segment and mentioned that tighter financing norm has been another key concern. And finally, specifically in the terms of near-term outlook, FADA has mentioned that the 5 consecutive months of declining sales is a negative, but the month of March and April has a lot of festivals like Holi and Gudi Padwa, and that might lead to revival in terms of sales growth. But most automakers are expecting a decent March to end the financial year on a strong note.
Now, on the sidelines of Birla Opus Paints inaugurating a first-of-its-kind paint studio in Gurugram, my colleague Sesa caught up with Rakshit Hargave. Now, he's the CEO of Birla Opus Paints, and he spoke to us about the company's demands in the last 6 to 8 months. He also shared his views on the company's objectives for the second half of FY26.
So the demand for paints, as we have seen and talked about in the last 6 to 8 months also has been relatively slow. So we can see that what we hear is the general slowdown in the consumer industry. The building material, the paint industry has also been through that. But maybe with the start of the new calendar year, things we hope that should look better. But whether it will look better very soon or whether it will take some more time is for us to see.
So by the start of the new calendar year, as in you're talking about the next year?
No, January, February. So, we are hoping that with the new calendar year starting, people do more painting jobs, take more resolutions and the business works up.
All right. So maybe is it fair to assume that the second part of the next fiscal might look better?
So we hope so, but I think we'll have to wait for some real trends to come for us to make a more strong comment on that.
And Prime Minister Narendra Modi participated in Uttarakhand's winter tourism program. He emphasized on the government's focus on developing eco-log huts, convention centers and helipad infrastructure in the hills. He shared that before 2014, an average of 18 lakh pilgrims visited the Char Dham Yatra annually, which has now risen to approximately 50 lakh pilgrims each year. The Prime Minister further said that there shouldn't be any off-season. Instead, tourism should be on in every season in Uttarakhand. And popular YouTubers Ranveer Alabadia and Apurva Mukhija appeared before the National Commission for Women today in response to summons related to controversial remarks made on the show India's Got Latent. The NCW had initially called for the appearance of multiple content creators, including Samay Rana, Jaspreet Singh, Ashish Chanchlani, Tushar Pujari, Saurabh Bothra and Balraj Ghai. However, none of them appeared last month, citing concerns over personal safety, travel, commitments and logistical difficulties. And some international news coming in. US President Donald Trump threatened further destruction of Gaza if all remaining hostages were not released. This comes only hours after the White House confirmed direct negotiations with militant group Hamas. Trump sent billions of dollars in weapons to Israel, demonstrating his unwavering support. International rights groups are demanding that Israel provide humanitarian access to Gaza after the country blocked all aid to pressure Hamas into accepting a new ceasefire agreement. And before we go, the world is gearing up for the celebration of International Women's Day on March the 8th. And on account of this special day, NDTV Profit spoke to a host of women leaders across India's business and finance sector about why we don't have enough women leading corporates.
It's International Women's Day. While we celebrate the success of women across sectors, there's still a long way to go, especially in leadership roles. Women only make 3% of CEOs, while organizations that prioritize diversity actually stand to make 21% more profits. So, why are women still not in leadership roles?
What women face is a multitude of reasons. It could be bias, but I feel bias is a small factor. It's also because of the life cycle. There are women who discontinue workforce. So currently there are very mindful measures to include those workforce back to office.
I have been in the IT sector, and an off-site posting was considered a valuable experience. And there was one woman employee working in a multinational company who said that she was never considered when an opportunity for on-site came up, to go to the US or Europe, etc. So when she asked, they said, no, but you have your family to look after, so we don't want to break up your family.
Though businesses with more women in leadership positions tend to make 21% more profitability, lack of mentorship and unconscious bias remain major roadblocks. So what can be done to push more women into leadership roles?
They are very efficient, they are multitaskers, they're looking after so many things, balancing the budget, looking after the children, the family. But when it comes to professional work, women lack confidence because they have been told that leave it to the men. It's their job to earn the money and look after you. Very conscious decision has to be taken by the financial sector to see that there is a level playing field. And when it comes to investment, whether by the government, whether by investors, whether by banks, gender segregated reporting system has to be there to consciously see if women are being left out, and if so, why.
While the numbers might not be where we want them to be, the progress is gradually happening. As more organizations invest in diversity, we will truly have a leadership that reflects the workforce.
So one of the tools I would strongly urge all of us women to use is the 50-30-20 rule, where 50% of everything that we earn every month goes towards necessities, 30% is for wants, that's your discretionary spending, and another 20% towards savings. This is what goes towards your long-term investments and your future financial freedom, extremely important. So ladies, when that urge hits you to go out and indiscriminately shop, I would strongly urge you to lock away that credit card. Jokes apart, anything that you do that eats into your saving kitty seriously impacts your future life. In fact, as women, I would say so many things affect our earning capability. It's extremely important that we save even more than 20% if we possibly can. And that's what will really see us, through the long and happy life that we each hope to lead.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. And as has been the case this week, we're talking about yet another company which has been very recently listed. This one is from the consumption space, but it doesn't cater directly to the consumer. It actually does cater to a lot of the companies from the diamond and jewelry space, and that is none other than International Gemological Institute of India, IGIL as it is known as well. And this one basically, serves as a place from where you do get independent certification and accreditation services for, the fields in diamonds, gemstones and jewelry. And it has about, pretty steady 65% market share in lab-grown diamonds particularly, and about 42% share in the jewelry certification segment. So it does have a lot of dominance in it, and it doesn't just have operations here in India, it has operations abroad as well. In fact, one of the objectives of the recently listed IPO for this particular company was also to take on the Netherlands and Belgium units under its own wing, which it bought over from its promoter. So, of course, we'll talk about that a little bit more detail a little later on. But for now, in terms of services that the company does offer, it includes diamond grading, quality evaluation, grading and assessment, and along with that, it also conducts educational programs. So, think of it as this way. We do have rating agencies which actually takes on, rating of several financial instruments of, say, for example, a corporate, and it assesses, makes the assessment, and then issues a certification based on the risk that may be associated with that particular security of a corporate, and that's the role of a rating agency. Similarly, what this particular company does, it actually rates for example, a diamond or a set of stud jewelry, and gives you that certification, and it gives you just that much more of an accreditations which suggests the quality, will give you the quality of that particular piece of jewelry, or for that matter the diamond or a precious metal that you are purchasing at that point in time. And this is not necessarily just for consumers, but also it's more of a B2B process. But now that I've made a mention of what the particular company does, let me also tell you about how we in fact can address this, take this forward in terms of what the company has done. So as we always do, we consider the fundamentals of a company. So we talk about the income statement, we also address the balance sheet, cash flows and return ratios, some very interesting data coming through as far as these aspects are concerned, some very large changes coming in as well. Of course, we move beyond the financial statements, and then that's when we also address what's happening in shareholding, street credentials, valuations, as well as street coverage. It's a fairly newly listed company, so we don't have too much in terms of street coverage. Still, we have a handful of marquee brokerages who do in fact cover this particular company. We'll talk about that in detail as well. But as we always do, we start by taking a look at the fundamentals of the company, the financial statements particularly. And for that, let's get in Mahima Vajrajani, who will yet again shed more light into these fundamentals. So Mahima, good morning and thanks for joining in. Let's, as usual, start by taking a look at your operational metrics, particularly the top line and the bottom line and the consequences.
Right. Good morning, Agam. So, before I move on to the metrics, just a quick clarification. This company follows calendar year. So, the comparison that we've made is calendar year 24 to calendar year 23. Now, in terms of the top line, revenue has seen a 3-year CAGR of around 42%. In terms of calendar year 24, the revenue stood at around 1,050 crores, and this was around 898 crores in calendar year 23. EBITDA has seen an overall 3-year CAGR of 35%, which stood at around 600 crores in calendar year 24. Margins have improved from 55.2% in calendar year 23 to 56.9% in calendar year 24. And net profit has also improved from 331 crore to 427 crore. And net profit has had a CAGR of around 35%, which is a 3-year CAGR. So in terms of 3-year CAGR performance and improvement as compared to calendar year 23, this is all in terms of all 4 metrics, it's a thumbs up for the counter. In terms of the calendar year 24 performance, in terms of performance metrics, number of reports for them went up by 26%. But in terms of the Q4 performance, revenue growth and PAT growth overall were lower as compared to other jewelry companies. IGI's revenue growth stood at around 6%. This is the revenue growth, and PAT growth stood at 4%. But this as compared to jewelry companies like Titan, Kalyan and Senco, especially Q4 being a festive season and a wedding season, Titan clocked a revenue growth of 22% and a 48% growth in PAT. Kalyan saw a 20% growth in revenue and 68% growth in PAT. In terms of the overall Senco Gold, also revenue growth was at 37%. So in terms of all of these metrics, the revenue growth came lower for IGI as compared to these jewelry companies. The other aspect which was important to note in Q4 was the studded mix for jewelry companies, because there has been a downtrend. Titan studded mix was down by around 1% YOY. Senco Gold stud ratio was also lower on the back of impact of lab-grown diamonds. So this might have a sequential impact on IGI, because they are the ones providing certification for natural diamonds and lab-grown diamonds. And if studded mix goes down for these jewelry companies, the number of certificates being issued by IGI will also go down. And lastly, in terms of Q4, muted revenue growth was probably led by high volumes in lab-grown diamonds compared to the natural segment. Company also claimed that they did not see any seasonality in terms of its revenue, but there was also a shutdown being observed for around 15 to 20 days in November to manage their inventory, which also impacted their overall revenue. So in terms of the 4 metrics, of course it's a thumbs up, but Q4 was slightly saw a lower growth, and there was a shutdown as well.
So, we were actually on the fence on this one, or whether or not we should give this one a thumbs up or no. And look, there's no taking away the fact that the past few years have been very strong for the company. But Q4, particularly in this case, stood out. Firstly, because of the fact that they had to retract their statements and, reissue their financial statements for the 4th quarter of the calendar year gone by. The changes weren't very large. The changes were relatively small, but that, of course, was a concern. But more importantly, again, as Mahima has already mentioned, this is not a like-to-like comparison with all the other jewelry companies. It just shows you that if you do in fact have such strong growth for the jewelry companies, then why is it that this particular quarter has not been so good for IGI particularly? And of course, once again, as Mahima has mentioned about a handful of other aspects as well with respect to the studded mix, as well as, muted growth in the lab-grown diamond space. We need more clarity here. We need more of a picture in terms of how this mix has in fact changed with respect to the certifications as far as this particular company is concerned. So that's as far as your top line, your bottom line is concerned. And the hitch now is coming in the 4th quarter. Can there be an expectation of continuation here? Because we did see a lot of weakness after the company came out with its earnings. But, I talk about the balance sheet moving on, and it has, so firstly, its net worth, okay, that's the shareholders' value, has in fact gone from negative to positive over calendar year 2023. So that is, of course, a positive here. It does not have any gross debt, and in terms of cash in bank, those numbers have improved as well. But we'd also be very curious to understand how this particular net worth has gone from a negative 600 odd crores to a positive 1,000 odd crores. So that's something that we're going to keep an eye on. There is another aspect that we do need to address as far as its receivables are concerned. We would have given this one a thumbs up, but given the fact that we are also looking at a sharp increase in receivables. Firstly, in calendar year 23, there was 100% growth in receivables on a year-on-year basis at around 126. And even in calendar year 24, receivables have moved up even higher to around 164. One might suggest that this is actually an implication of the growth in business. We do take that point. However, the fact that your receivables are growing and they're actually outpacing the kind of growth that you're seeing is a little bit of a concern just at this moment, which is why, of course, we're not going to give this a thumbs down. It's just one of the parameters we thought that we should highlight before we bring in your overall balance sheet details. So, and hence, it's going to be a neutral here. How are cash flows looking, Mahima?
Right. So for cash flows, in terms of cash flow from operations, they have been improving as compared to calendar year 23, where cash flow stood at around 303 odd crores. It has increased to 393 crores. This could have been a better number in terms of calendar year 24 if trade receivables did not, increase by the bit that we talked about. But still, cash flow from operations is a growing number. But in terms of net cash flow, the net cash flow in calendar year 23 stood at 55 crores, which was a positive number, but that has turned to negative 60 crore, and this is because of a 1600 odd crore cash outflow in the investment activities.
Right.
So we'll have to, even go to the management and see that where this money has been spent and why the cash flow has been negative in terms of calendar year 24, which is a 60 crore negative number. So because of that, negative 60 crore number, we've given it a neutral rating.
Yeah.
But overall, cash flow from operations have improved in terms of in comparison to calendar year 23.
Right, absolutely. So that's as far as this aspect's concerned. We talk about the return ratios too. Again, very healthy return ratios of around 48-50% for both ROEs and ROCEs. So there's no problem here. Given the fact that it has a very strong operational metrics in terms of your operating margins as well, these numbers are expected to remain higher. But let's talk about shareholding as well, Mahima. That's another interesting one, yeah.
Right. So in terms of shareholding, this parameter we've given a thumbs up because promoters have a strong holding of 76.55%, and this of course will come down to the 75% threshold that is required by law. But FIs are holding around 9%, DIs are holding around 5.8%, and around 8.5% is held by public. So in terms of the overall free float that is available to public, that's around 8.5%. But in terms of the pledge that we were talking about, just before the IPO, the fresh issue was for approximately 1475 odd crores, out of which 1300 crore was for paying off the promoters for buying off the Belgium and Netherlands part of the company, and the promoters had their pledge against that holdings, and that pledge is now, the encumbrance has now been removed if we check the as of March data. Right. So that has that's probably a big positive coming in for the company.
And who's the promoter, Mahima?
For them, the promoters are, if I'm not wrong,
it's Blackstone.
Blackstone, yeah. So Blackstone are the promoters, and so that's how the entire transaction has taken place, and which is why we've given a thumbs up for this particular counter.
Right. I just want to mention one more thing. There are a handful of sovereign authorities who also own stake in the company. So you do have Abu Dhabi as well as the Singapore, sovereign entities, which in fact do own about 1 to 1.5% as far as this particular company is concerned. Besides that, there are plenty of marquee AMCs in India as well who do have ownership in this particular company. So we have a well-rounded institutional involvement in this particular company as well, notwithstanding Blackstone. The only issue that we perhaps need to understand is that the shareholding still shows encumbrance. And of course, this is shares pledged to Deutsche Bank. So we will get more details and clarity from the management on this one as well. But moving on, I will talk about street credentials. And when it comes to this one, look, we know that it's been a tough period for the mid-cap and the small-cap companies here as such. And this company has also been a victim of this precipitation that we've seen over the span of the last 5 months. The stock has, of course, listed at 510 on the NSE, and that was at a premium of around 22%. And since then, it has come off quite a bit. In fact, today, it's trading at a little over 320 odd rupees per share. So as you can imagine that we have seen that correction, a very sharp correction as well. And one of those companies which in fact have taken it up the chin, along with a lot of the other IPOs, which did show a premium on listing day, but have since come off significantly from not just their issue price, but also their listing price, whether if you consider the high or the low. But, in general, otherwise, not much to talk about. That's how, street credentials are. Mahima, how are valuations looking?
Right. So, for valuations bit, if we see the estimates for 2025 as well as 2026, the PE ratio for IGI for 2025 estimates suggest that it's at around 42 times, and this will go to around 36 times. So not looking very cheap, although IGI has no direct competitor. So there is no peer comparison for this particular counter. But overall, if we see the kind of valuations that are being pegged at in terms of estimates, the EPS growth suggests a 20% growth versus that of a valuation of 42 times and 36 times in 2026. Revenue growth is pegged at around 15% and overall FY26 estimated price to earning growth is just at 1%. So if we see all of these metrics, the counter looks a bit expensive, which is why we've given it a neutral rating for now.
All right. Well, there you have it. So that's your, price to earnings valuation. Of course, as Mahima mentioned, the PEG ratio is at around 1. So it's a fairly neutral one, keeping the growth in mind. And we're penciling at about 20% growth here. Well, that's as far as your PEG ratio is concerned. That is price to earnings to growth. But finally, actually, Mahima, why don't you take us through the analyst recommendations as well? We just have one right now, Morgan Stanley, who incidentally, by the way, were also their book running lead managers here. They have, in fact, after, a few weeks after the company listed, have also made an initiated note on this one. What are they saying, Mahima?
Right. So Morgan Stanley has initiated coverage, as you rightly mentioned, and the target price that they've given is 617 for this particular counter. What they're saying is that for IGI, there are high barriers to entry, and that is the key moat. In terms of an India production story, in terms of lab-grown diamonds, they are not there yet. But overall, India consumption story for natural diamond remains intact. They're expecting IGI to deliver a 15% and 20% revenue and PAT CAGR over calendar year 24 to 26 estimates. They're expecting EBITDA margin expansion from 54.6, that is in calendar year 24, to around 56.9 in calendar year 26. And, just to mention, they've already done margins of around 56.9% in calendar year 24 itself. In terms of PE, the target PE is of 60.2 times, 47.5 times and 23.8 times is the bull base as well as bear case scenario for this particular counter. So overall, they are bullish when it comes to this counter, and which is why we've given a thumbs up. This is the only broker that right now kind of has a coverage on this particular counter because it's a recent listing, and so overall, because they've initiated and they're overweight on this particular counter, we've given it a thumbs up.
Okay. All right. So I reckon that this is a good time to get the management in. And we, in fact, do have Temas Printer. He is the MD and CEO of the company, along with Ishwar Iyer, the CFO, who is joining us on the show. Good morning to both of you, and thanks so much for joining us here. And Temas, I'll start with you. Now, overall, over the last 3 years, we've seen stupendous growth for your company in terms of your top line as well as the bottom line. It has been very evident, the growth. But the question really is that the fourth quarter did throw a little bit of a concern with respect to at least the near-term growth looking forward. I know that this is not a like-to-like growth. While the industry and the jewelry retailers have done very well, that hasn't exactly translated for the growth of the quarter gone by. I'm not talking about the entire financial year. One, is this a good way to look at things? And two, if you could also tell us about what has contributed to the growth, or rather the at least perceived lack of growth in the fourth quarter. If you could give us a little bit more detail here.
So basically, IGI is a growth story. We have delivered growth over the last many years. And if you see the year on year, our growth is at the levels that we specified, even initially. So it's just in the last quarter, there was some bit of correction. Because, the LG prices, diamond prices were at, they were under pressure and, we were holding on to our certification costs for at least 6-7 months. And finally, last year, in around April, May, we had to take a 20% cut to correct the incremental certification cost per LG diamond. So initially, while we used to certify 30 pointers, the demand, because of the affordability of the LG lab-grown diamonds, we are now averaging 1.5 to 2 carat plus. So the bulk of the certification now is coming through the higher weight of the lab-grown diamonds. So while there has been a price correction, at the tail end of the year, we have adjusted. But if you see the overall picture, we are on par and in fact going beyond.
Okay. So at the moment, Themas, my question then is that are you likely to see more of a shift towards certification of lab-grown diamonds as compared to your traditional sources? And keeping that in mind, do you think that there could be any issue with respect to profitability? And by that I mean your operational metrics.
See, the thing is, both are diamonds. You have to understand that lab-grown is a new kid on the block. It's a disruptor. The diamond market never had a disruptor in the last 100 years. Okay. And at IGI, we were very cognizant of the fact that we are an independent international certification body, and we will give analysis of any stone, gemstone that we are paid the fee, we will honor it. It's our integrity that counts. So it's not that, we have a bias towards natural or towards lab-grown. And because of this factor, we have taken the lead in the lab-grown sector. And we have today around 65% of the global certified diamonds of lab-grown certified by IGI. At the same time, we are not B-grade diamonds. So natural is also for us. Lab-grown is also for us. The most important factor here is to determine the origin of the diamond, and which we have a legacy of 50 years and we have the expertise. Because, both the diamonds, chemically, physically, crystallography, both are made of carbon. You and me are made of carbon. So everything is very similar. Is the same rather, not even similar. So to identify the different origin, one is earth mined, one is man-made. And that requires a lot of expertise, and IGI has that. And we have used this expertise because the only difference really between the two diamonds is the commercial value. One is considerably affordable and one is very expensive. So, what lab-grown is actually doing right now, is increasing the consumer base. The millennials and the Z generations, all aspire to have a diamond. And today they have an affordable alternative. They have an affordable diamond. That's what I'm trying to say. And this is where we see the industry progressing with a huge number of consumers coming into the fray. If you see statistically, 1.5% of the Earth's population buys diamonds.
Right.
And these are all natural.
Got it.
Today, with the price points and affordability of lab-growns, this is fast expanding.
Got your point. Right. Got your point, Themas. Ishwar, I'll come to you. Right now, what is the mix like, lab-grown diamonds versus natural diamonds? I just want to get my facts straight here. What's the mix like, one thing, and what is the actual difference in terms of percentage when it comes to, the price that you're charging for a certification of a lab-grown diamond versus that of a natural diamond? Because then I want to understand the impact, overall impact on your bottom line.
Okay, so Mahima, I've been listening to the detailed analysis that you were presenting. It's very, very comprehensive. So, it's awesome analysis that you've actually done on the IGI performance. Okay, so let me just set a few things in context before we get into the nitty-gritties of the question that you asked. Okay. There was one discussion point. I'll just move away from the financials for a moment in terms of the shares that has been pledged by Blackstone. There was a clarification that we had given even to SEBI prior to our listing. There is at the moment, or even in the past, shares that have never been pledged by Blackstone. So I just want to put that record straight so that there is clarity amongst everybody who is watching the show. So there are no shares have been pledged by Blackstone, and Blackstone holds close to 76% of the company post the IPO. Yeah. So number two, in terms of what's happened for the business for the last 12 months, and then we'll talk of the quarter. The business, there was a couple of things that we did as part of the IPO process. There was, as Themas did mention, we have been in this business for over 50 years. We operate in 8 to 10 countries. We had 3 holding structures. We had a holding structure in India, and Belgium and Netherlands. As part of the IPO process, IGI India is now the holding company for the group. We've acquired both the IGI Belgium as well as the IGI Netherlands business as part of the commitments that we made in the RHP. So close to 1350 crores of funds that is which came in from the IPO. We used that, around 1300 crores of that, plus another 60 crores from our bank to fund the acquisition of both Netherlands and Belgium. A critical aspect here is the brand was always owned by Belgium because that's where the business started. And through this acquisition, now we have also the brand directly under the ownership of the listed company in India. Okay, so that's an important point that I just wanted to bring to your attention.
Right.
Now coming financial performance, of course, we've grown close to 17% from a revenue standpoint for the full year. And that is on the back of about 27% volume growth. So the key volume growth that's happened for us over the last 2-3 years is driven by the lab-grown segment, which Themas mentioned being the new disruptor. So that's become, it's a category which is affordable with the pricing structures that is available there. So that is the key driver of the volume growth as well as corresponding revenue growth.
Right.
Now, of course, what's happened is because of the nature of the industry, while natural diamonds are scarcer, it takes over 1 billion years for it to build up in the Earth's crust, etc. Then lab-grown diamonds is man-made. So we have equation of demand and supply, therefore playing out as far as lab-grown diamonds are concerned. And the lab-grown diamond therefore saw a correction on pricing, either from the Q4 of 2023 till the first quarter of 2024. Corresponding to that, we had to therefore correct our certification pricing. And to just answer to what Mahima just mentioned, our certification is around 3 to 5% is what we charge as certification if you were to compare to the pricing at the wholesale level.
Right.
So pricing impact which we took in the month of April, May, consequent to the price correction of the lab wholesale level, is what caused a little bit of softness in Q4, because the Q4 of 2023 was also extremely strong from a volume standpoint.
Right.
And the other point that Mahima asked is in terms of our business mix at the moment. Equally between lab-grown as well as natural diamonds.
Okay, well, Ishwar, unfortunately, we are completely out of time. So we've registered all the clarification that you made with respect to encumbrance, as well as, how business has shifted, and also the kind of correction that we've seen in terms of, the price correction that you have taken. So all the points taken on board. But at this point in time, we are completely out of time on this edition. So thanking both of you for joining us and taking us through, all the parameters with respect to your business. But on that note, it is also a wrap on this edition of KYC. Lots more lined up on the other side. Stay tuned in.
warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come.
Hi, we're talking about Your Money Matters, and this is NDTV Profit. Well, on this program, we speak about everything personal finance related. We also speak about mutual funds. And on this program, we like to bring the people who manage your money on so that you can understand how they're looking at risk assets, how they're looking at the markets in general, not just equity markets, but the fixed income market as well. And so that you understand how to tactically set your investment strategy. Joining me today at the start is Ramesh Mantri, the CIO of White Oak Capital AMC. Ramesh, absolute pleasure having you on the program, and I think it's a crucial moment that we're speaking today because some investors who have gotten in over the course of the last 12 months might have their confidence shaken based on what we've seen in the markets over the course of the last 5 months. We've seen the benchmark fall 5 months in a row, which is something we haven't seen in practically 30 years. So how you're positioning yourself and your portfolio is going to be absolutely crucial and key from their perspective as well. So first of all, thanks for joining in. Let me ask you about your Balanced Advantage Fund, because this really is going to give me a perspective of how risk on, risk off you are.
Yeah, so on a Balanced Advantage Fund, the neutral equity exposure is 55. As we speak, we are running more than 60, which is at least 10% overweight and neutral. So our model is clearly indicating that there is clearly now an opportunity to allocate more to equity. And in fact, it's the highest in the last 2 years that the model has indicated equity allocations in the portfolio.
Okay. So help me understand this model as well, right? So as I understand it, your Balanced Advantage Fund would go to a minimum of 30%, but largely it would fluctuate in that range of closer to 60-65%. Is that the right understanding?
The neutral level is 55, which will be closer to 55. So as we speak, we are running it at least 10% overweight the neutral level.
Okay. So the interpretation of that, therefore, Ramesh, is that you are far more sanguine, you're far more comfortable with the valuations of the equity market as they stand right now. But is that true across the board, or are there still pockets of too much froth and areas where you are avoiding?
Yes, so clearly it's not that the opportunities across the board. I think the large caps are clearly attractive, at these valuations. And by the way, the Balanced Advantage Fund the portfolios are by definition more tilted towards large caps. So that's the most attractive part of the market. I think there is still, while small caps and mid caps have corrected more than large caps, but I think still the valuations are not. So the large caps is in the green zone, the mid caps is in the yellow zone,